Nice. So, good night. So, we have some new persons in here, so we'll just go over the basics of what we're doing here, and even if intermediate, it don't matter, right? So, regardless of where you land in this class, in these classes, whether you're intermediate or you're beginning, the way the classes and the strategy and the information is structured and designed, everybody could benefit from it, whether or not. And I think that's a unique thing that we have here, based on trading. And we start beginner classes and then intermediate, and we have advanced stuff that we will get to, right? But generally, the strategy that we just do is one simple thing that we just replicate, right? Now, some of you may have experience, some of you may not, right? It doesn't matter. Now, what we do in here, right, is pretty much the same things, and I'll give you the basics of what they are. So first and foremost, when you come into the group, right, so this is for beginners and even the intermediate ones. I want us to fundamentally, to the core of it, understand what we do in here and what we're trying to achieve, right? So if we have a clear goal or a clear direction and we head in, we would understand what we're doing and we would treat the system as such, right? So when it says you come into the group, this is not a signals group. The money you paid is for education. You paid money to learn how to do this thing in particular here, and we learning to do it profitably and sustainably. What I am doing is what you want to achieve. I don't want you to do your own thing. Whatever you know, forget. The reason why I'm telling you whatever you know to forget is because it hasn't helped you thus far. If it could have done it, you wouldn't be here, right? So remove all preconceived notions of what you think going on. Whatever you feel you know, you don't know, right? Just empty the cup and fill it with new information, right? So come in as if you're brand new. Some of you may be brand new, so if you are, just listen to everything I'm telling you. The things you want to achieve is what I am doing. The strategy that I use is proven over years, right? So what we do in here is looking for proper entry points into the market. Entry points meaning good prices to buy and sell particular commodities, stocks, cryptos, assets, right? Essentially, that is what we are looking to identify. Good prices. You are a trader, you consider retail, you are also a financial analyst. This tool here is where all the money is. It is a very powerful thing. If you come onto this thing that we're doing here with your focus as money, you will not make any. No, it kind of, it is say it like that. It's like, but trading is about money. It is, but it also isn't. Your focus should be understanding why these things move, how they move, and try to follow the patterns. It is very data driven and it is pattern based. Everything that's happened everywhere on all time frames. So every pattern is occur on all time frames across all asset classes. It doesn't matter. The only things that is different is what does drive it or what does move the price of a particular thing, which is fundamentals, which we will get into, right? So this is the basics, the basis of what we are trying to do here. Identify good prices to enter the market at. What we using is a mix of fundamentals and technicals, right? Which I would explain a little bit more deeply for you as we go on, right? Now, to go back to the point as to what we doing. If you're focusing on the money, you lose money. What you should be focusing on is learning the skill, the money and the skill. If you are practicing, practice what I am teaching you. Do not practice what you used to know and what you think you know. You don't know anything. Practice, if you must, on your demo account, what I am teaching you. That is why you're here. So, you see, last week, real people get chopped up very bad for no particular reason. There is no, if you're losing your prop firm account, which is essentially, like we say, 10%, which is $1,000, it's rubbish because it's the same amount of money you're putting into your trading account. If you're losing $1,000 account, it's trash, There's no reason for you to lose a whole $1,000, $10,000, $20,000. So the money obviously don't matter how much you have, because you get more and you didn't manage it well, right? So take your time. Instead of upping your leverage, meaning trying to make more money fast, what you should do is lower your leverage, use less money, and extend the time it takes you to make money. So a lot of people that's coming into trading because they want money fast. It is not designed to give you money fast. You think it is. It isn't. If you get money fast, you will also lose it fast. Easy come, easy go, right? The mindset of what trading is more important than a winning strategy. It don't matter the strategy. It don't matter if you get good signals. If you have any one thing missing, like Larry saying, not managing your money well, you are going to lose money, right? So it don't make sense. So lengthen the time that you're expected to make money for, right? Instead of saying I want it by month 10, I'm willing to see how I reach at this time next year. And I'd say it might take you a year, it might take you 2-3 years, it might take you a couple months, you don't know. But extend the time and just give yourself that grace and that patience to get there, right? So what we do is we look at the charts using a mix of fundamental and technical analysis. Fundamental analysis is what is make the thing move. Fundamentals is economic data, government issued announcements based on currencies and different happenings in geopolitics and the world. It is why things happen, right? So is the market sentiment, is the sentiment of the people. Fundamentals are arguably more important than technical data. Technical data is the fancy lines that I see. Technical data is a visual representation of the fundamental data that we have. Fundamentals kind of in the air, a mystery. Right? This is what we think happening, we feel happening, the vibe. The technicals is the visual representation of that. Technical data, the lines on the chart, are macaronis. If you hold a macaroni in your hand, it's relatively sturdy. But any pressure applied to it, it is break. So you must be willing and able to change your bias based on what the fundamental data is doing. Right? So I say that to say, if you are in a trade for whatever reason, do not hold on to any bias for any lengthy period of time. Where you feel, no matter, look at the data. This whole thing is data driven. The chart, the market, these candles will tell you what is happening. So I keep telling for the one to hear long enough, you would hear that I always say, do not predict where the market would go. You have no clue, right? It's like tonight a guy say, but gold might reach whatever price. You don't know. Don't even worry about where it's going. It could go to $1 billion, it could go to 0. It doesn't matter. Observe the chart, pure price action, and it will tell you what we're doing, right? Now, even without fundamental data, you can look at the chart using the technicals and make determinations of what might happen or what may be happening. So we use certain strategies and certain positionings of the lines to identify particular things going on in the market. So the first thing we just do is we just start on the daily time frame. The daily time frame is considered a higher time frame, right? It is a time frame that does indicate overall chart sentiment, overall market movement. It does give you a general idea of where the market going overall, right? If you start to lower a time frame, what would happen is that you will get a false bias because all candles in candles, right? So you will get 5 1-minute candle and 1 5-minute candle. So you could see 5 candles, but you only spend 5 minutes. And if you go up to the 5 minutes, you will see 1 candle. So you will get false data or too much information. So we start on the day to get an overall bias. The reason why we want the overall outlook of the trading is so that we could get a clear picture of the direction the market headed. The direction the market is going is very important because you want to go it's like a river, like a stream. You don't want to go against the river or the stream. You want to go where it's going. So you want to go with the current, it's easier to go. And so in this case, you want to follow what everybody else doing. It is also a place where we could identify institutional buying and selling, which is pretty much banks, the people with the money, right? None of us here could move a candle. We don't have enough money. The people who move in the candles have the money and they know why they move in the candles in particular directions. What we're trying to do as retail traders or intraday traders is identify when they actually enter the market and take trades alongside them, because they're going to push it in a particular direction. We see little guppies, we could just feed on whatever they're doing, right? Because we can't actually make decisions here. We could identify when they make decisions. So that is what we're doing, right? And within that is where we find entry points to either buy or sell a particular asset, right? So we started on the daily, and the first thing we do on the daily is we pull our trend line. The reason why we pull a trend line is so that we could, one, identify the overall direction of the market, and two, we could also identify potential entry points. So the market, see how all here is this blank space, right? Anything can happen anywhere, right? What we use the trend lines for is to identify potential open spaces that the market could react off of. If we go back here and we draw the same thing we're going to draw, you will see patterns emerge, right? The people, humans, us, we like to buy and sell at the same prices, right? It's just human nature. This is human fear and greed plotted on our chart. This is humans, this is people, right? We have prices and places that we like to buy from, right? We like repetition, essentially, right? So when we start on the daily and we pull the chart, we pull the trend line, we could, one, identify clearly that the market is ascending. So it is going up in value, regardless of, but who knows, nobody traded, we don't know what's happening. But overall, the market is still heading towards going up in value, right? Which is gold. This is the only thing I trade. Now, the next thing we just do is identify support and resistance zones. So support and resistance zones is essentially a ceiling and a roof. So a support zone would be the lowest area that the market reach after consolidation. Consolidation is where the market can't pick a direction, right? So you would see that the market going you would see that the market as be going up like this sometimes. Okay, no, yeah. Right, so you can see the market as be going up like this sometimes. Right, the market as be going down like this sometimes, and then other times the market is just be going across. Right, so consolidation areas is where we would identify when the market slow down. So from here, it's easy to identify when the market does decide to pick a certain direction. So we look for consolidation, so we use that as places to draw support and resistance zone. Right, so anywhere the market looking like this, chopping around and not going in any clear direction. Right, what we want to do is identify when the market deciding to go up or down, right? But when it's doing nothing, we don't do anything. So we just look at it as a place that is not doing anything. So from here, out of this, it's going to go one out of two ways. Either it go up or it go down, right? But it's easy to identify from in here. So we have this. So this is support. This is the bottom area of the same thing. What we would then look for is the highest point that the market reached. And we do the same thing. So you see we get a wick and we turn around from. So that way the market was selling here, and then it started going to consolidation, support area. This is the bottom. Market was buying, it turned around from here. This is the highest point it reached. This is consolidation. Alright, or a reversal point. A key level, a point of interest. Something happened here to make the price turn around. The price went up all the time, and then something happened here that made the price change direction and go down. This is a key level, a point of interest. The market going down all the time, something happened here, and then the market change direction and go up. This is a key point of interest. So what we would look for is key points of interest. So we could see a key point of interest here. The market was going down and then it go up, and then there's another key point of interest. The market was going up and then it started to go down. Right? So within this area here, on a high time frame, we could identify the overall market structure. We could identify where the market reached at its highest point relative to where the price is. And my price line come off for, I never could find it back there. Here's what I got over now. One out of them thing. And not this way. Anyhow, I'll find after. Anyhow. Right? So relative to the price. So on your chart, you might see a dotted line somewhere here. Right? That will be the price line. So relative to the price. Relative meaning closest to the price. Right? So this is the highest point, closest to the price somewhere here, and then the lowest point, closest to the price somewhere here. So we have a trade range. Now, we're not going on higher time frames because we intraday, we still looking for trades almost daily, every other day, something like that. Right? So remember, we using it to take trades kind of in and out. Another reason that we just use, now we're not going up on any higher time frame essentially, is so that for us to be able to take trades that we could actually hold, we need to risk less money. Right, so we need to have tighter stop losses. If you're taking trades on the daily and you risk a certain amount of money on a high time frame, it could be too much money that we could afford essentially. So we need to be on lower time frames essentially to be able to get, to be able to risk properly and still take trades often enough to survive essentially. Right? It's not trade is not an income source necessarily, more of an investment tool, but you can use it, as income once you get a fair hold and understanding of it. Right? There are quite a few people that myself included, that do use it for income on a consistent basis, right? So now, after we get the overall structure in the 4 hour, we would then come down to the daily, we would then come on to the 4 hour to get just a clearer picture. It looks a little bit different now. We can identify little zones and stuff within here, and see if these two high and low points, match up properly, so we can see what happened a little bit better. So for right now, everything's set up. It's not really nowhere close to anything, so we could then go down to a lower time frame and maybe make get other little zones. Now, I don't really like the area this at, but for the sake of this class, I would still do it. Right? Now, we have the daily overall, right? So we have the highest and lowest point of the market reach on the daily. Now on the 4 hour, we could then make a smaller little zone. So we could do the same exact thing. Now be careful of drawing trend lines in here. Trend lines in this area not as sturdy as the overall one. So generally, I would only use one trend line. And the trend line would be on the higher time frame, the daily. Now you can pull a 1 hour trend line, right? But it must have a clean structure that was created in order to use it. If it don't make a nice clean structure, then it don't really make sense to use it. Because inside of here, although it may have moves, it is still consolidation essentially. Right, so you have to be careful of that. So always remember, within here you're in consolidation kind of way now. And so be mindful of the zones that you have in there. Now on the lower time frame, we had this gap. This gap does just always confuse me, but we could go with this area here. Right? Now we go with here being a low point for the market. Right? Now you could see that the market, if you draw this line, you can see that the market sell, react from here, turn around, come back, do something here, turn around, come back, do something here, turn around. So this is a valid support and resistance. Right? So my candles in candles. Right? So support and resistance inside a support and resistance, candles inside a candles. Right? Same thing here. So when it was below, the market buy in, touch this area, sell, buy again, touch area, it sell until they finally break. Right? Remember, the line is macaroni, and there's only so much legs it could take. So we have our next little trading range that we identified. So overall, we know we're going up. We have a big zone, right, which is possible entry points, major zones you get big reactions off of, right? And then we have these little zones inside of it that we can easily or better see, right, in order to take entries on, right? Good little prices. So if we draw this here, you can see, right, same thing. We get reactions, right? If we draw it straight out, buy, do something here, sell off, right? Break through here, we get all of this, no problem, right? Same thing here. It did sell, they get reaction. When it do break the line, it try to go back up, reaction, right? Cool. So within here now, what we could do is go down to an even lower time frame. So we just go in zone by zone. Now what we're looking for is reactions off of any one of these zones. I would show you what we're looking for when we actually reach these zones to be able to actually take entries, right? So you have a set of confirmations that you would look for at these zones. So when you identify these areas, right, what you would do on lower time frames is look for key confirmations that I will show you to be able to take entries at these levels. You're only taking trades at these levels. You can't take a trade in the middle. So sometimes you will say, but that trade is still valid. No, it isn't. It already passed too far away from these levels. You want to get trades anywhere in or around here. That is what you're looking for, right? So anything outside of these areas, you don't take trades from. You're looking for trades at these areas, right, on lower time frames. But to get the proper zones, okay, if you realize this is only 4 hour chart, so every one of these candles is 4 hours long. So when you reach any of these zones, one candle is 4 hours. So imagine how much hours of selling you could get. You get a nice move now, right? But you have to identify these zones that the market will get you big moves from. So when on low time frames, you don't get big moves. You don't make. So like if you notice my trading style for who in here, I might take less trade, but if you catch one, you catch one. You understand? Because you go move now. And once you start to move on here and you get to break even and thing, you make a nice little money. I think last week part of the reason I didn't run on the trade because we got a big move, whether it was a Monday or Tuesday, right? Like 5 times the money we would have make on that one trade or had a trade I in. So that I was so disappointed when men lost the account and then last week because we got a real nice trade. A lot of people catch it and men still going in and doing their own thing. It really hurt me to see, right? So within this little zone here, we could go up, we scale it down again to find better entry points. So we're actually going to click the button, we come on lower time frames. So sharper entries. We will see clearly what happening, right? So after the 4 hour, we could come inside like the 1 hour now, and we could then see how much clearer it's looking. Ooh, we could see market looking a little bit better here. We could break down the trades. Step by step now. We could break it down and see what we get. Right? Now here is where I may draw a trend line, provided we have clean market structure. In this case, I wouldn't consider this as clean market structure. Yes, I wouldn't draw a trend line. Right? You want to get 2 or more touches, but just some experience, I don't like this. This now super valid to me. Right? It could be, I'm not saying it can't be, right? But I don't like it just based on experience wise. And I prefer seeing a little bit clearer. So I wouldn't pull a trend line. But for the sake of illustration, I pull the trend line. Now, if I have to pull a smaller trend line, I would pull that smaller trend line on the 1 hour. I wouldn't pull it on anything lower than that or unnecessarily higher than that for what we doing in particular. And I'll put it here. So what we're looking for is a couple of places that the market touch or react from. That is what is determining where and how I draw my lines. I draw my lines at places that the market do something by. Pretty much doing something is changing direction. Right? So if you want to put it simpler, is either it break the line or it reject from the line. Break the line meaning you get a big candle like this by the line, you're getting big candles by the line, or it reach the line like this and turn around, or like it reach the line like this and turn around. That is what determines where I draw my lines, where the market turn around from, or where it break the line and we get a big candle. Any one of the two is fine. That is what we're going to use to identify the potential trades, right? Good. So make this one a little ticker here. Right. Nice. So now we have areas that the market do something at. The market do something here, it turn around here, turn around here. So what we're using is past data to make calculated future guesses. Right? So what we look for is because it did it once, it chances that it will do it again. If not, then we have something for that, or we know how to take trades based on if it doesn't. Right? So if the market come to this area and turn around, we know how to take entries based on that. If the market come to the area and break through it, we know how to take entries based on that. Right? So what we do in here, or what our strategy is a break and retest strategy, a change of character strategy, which is what they would be able to identify. Right? So break and retest, change of character, which is essentially a reversal strategy. So reversal meaning you want to be able to identify when the market turning around, right, going in the other direction, which is also like change of character. They're kind of interchangeable, right? So the change of character is when the market selling, we want to be able to identify when it's no longer selling and it's starting to buy, or we want to be able to identify when it is going to actually turn around and go in a particular direction. Same thing kind of way. It's just a matter of how it used, where it used along these lines here. So that's for instance, out confusion all there. The reversal would be to identify that the market reach up here and it go in and sell from here. Right? So it reverse again. Or to be able to identify when it change character and it break the market and then it go in and go up in a particular direction. Right? Cool. So we have these areas here, which are areas of interest. What we would then do is come down to the 15-minute time frame. This is our entry point. This is what we are going to use to identify or potentially take entries now. Recently, I started to use the 5 minutes and the 1 minute, which I would show you, and we could probably use them to take good entries. I wouldn't go over the RSI for you today. I would reserve that for another class, right? But this is something that does help in identifying potential trades, right? So what we're looking for at these levels is one of this here, a bullish engulfing candle or a bearish engulfing candle. Now I would have some chart pattern mark up in the group. This is actually a good trade, but I'm not going to rush to take any trades right now. I just rather play out. Patience is key, and I want to teach. But I believe this is more than likely a valid trade, right? And I'm running down no trades. You get it, right? Cool. So the market reach one of these key levels and they see it doing a thing. So now almost perfectly to a T. Right? This is how key levels does work. The same thing you watching, everybody watching. Right? What we would do, what I would show you is how to use them properly. Right? And identify proper moves now. So what we will be looking for at an area like this or area like this is bullish or bearish engulfing candles. A bullish, and I'm going to say that an engulfing candle is one big candle noticeably bigger than the rest. You can't miss it. It will look like this. It could be a big one, a huge candle, something like this. One of these, right? You can't miss them candle. One of these. When you see it, it does feel something when you see it, like whoa, and it's like I see it in the group day. So I said that big red candle, you can't miss that big red candle, right? What we are looking for is to identify one of those candles at one of these levels. What that candle in particular, because you notice all the candles looking similar, but not quite, each one kind of a bit different, right? This is where studying the candlestick Bible does help you to understand what each one of these candles mean. I am actually not going to go that far back to help you understand what each one mean. Yeah, they kind of putting on the left one. So there is the candlestick Bible in there. Read it, watch it, stay at the chart. You will figure it out. So what we will do is look for one of them candles at any one of them levels. So if it's up here, you can look for a big one to like this to break the level, or at the level you can look for a big one to turn around. This would still be considered an engulfing candle. The reason why not as big as some of these, however, it is still considered as one because if you notice, this candle, which will be red on your chart, is bigger than two candles. This one candle engulfed these two candles, maybe even this third one here. So you take three of these green candles and then one of this red candle here, right, to cover these. So it is a a bearish engulfing candle. Bearish is going down, bullish is going up. The bears are red, the bulls are green. You'll figure it out as you keep going, right? If it is new. So what we're trying to identify is when we see one of these. This is one of the first actionable things you're going to look at or use. Now this would happen on any time frame. Now as I say, I sharpen up my my trading. So normally I would wait for a 15-minute one to close, but I started to part of my reason. So for those of you who know that I was shocked and alpha, part of the reason that I there with them is so that I can learn too. Right? Them fellows them have a couple of years of experience under the belt, and there are things that I can learn. They trade on lower time frames quite successfully. I don't do it, but I could still incorporate their strategy into what I do, and I have been doing it, and it has been working out quite beautifully. So if you come all the way down to a 1 minute candle, so you can see before a 50-minute candle was one big one, but if you look at it here, you can be able to see this candle a lot earlier. You see, same bullish bearish engulfing candle, same candle. Now what this would do is identifying it on a lower time frame is it will give you a tighter stop loss, meaning that you could risk less on the trade. So one of their specialties is tight stop loss. Them don't put no money on that trade. Right? No, they may have a lower win rate, right? Because you money on a lower time frame, you're more likely to hit stop loss, right? Because it is moving so fast on these lower time frames. However, you will lose less. And overall, when you do catch one, you're still catching the big move that we're looking for. Ultimately, my trading style was I used to give it more time, so I used to just let the whole thing play out and then pull back and then catch it, which is fine, right? I do it rather successfully, but no reason why we can't do it better, right? So we're still learning. So at these zones here, you already have a bias, or you're already expecting something to happen. What you would do is come down to these areas here and look to identify one of these. So let me go back up to the 15, right? There it is. Nice. So at this area, or at any key area, right? So let's zoom out. Don't forget what we're doing. Key areas, right? So we know the market come up here. So you're watching the chart until it reach up somewhere here, right? So either set alerts on the chart. So to set an alert, you just download TradingView as the app on your phone. You log in using your same profile, meaning your same email and password. And like when you're on your computer, if you set an alert, it would alarm on your phone. So you would know when the market doing something close to where you wanted to do something. So we don't predict where the market going. We don't know. We just anticipate where the market might go, right? So we know or expected that something would happen close to these areas. We don't know what, so we would wait and see. But we're expecting something. So when the market chug along, like we say, you're getting down here, you hold the trade till the next possible area, and the market has go towards liquidity. Liquidity is a term you would hear a lot if you're new. Liquidity is pretty much people's stop loss, right? Liquidity is where the money is. It have people who have the stop loss above this area going short, and have people who have the stop loss below this area going long. Long as buys, short as sells, right? Trading is a practical skill, so the more you do it and the more you involve is these terminology will come like second nature. So if you don't understand the terms right now, don't worry yourself. Just keep looking at the charts, keep looking at videos, you will pick it up. And it's like there's like a next language you learn. If you just keep talking it or you keep hearing it, you'll learn. Right? So don't bust your brain if you don't understand the terms now. And it's fine. So because we're expecting something to happen at these zones here, and we could then look or wait to identify something that could give us a potential move. So what we would identify first thing is a bullish or bearish engulfing candle. We're looking for a big candle to emerge. Either the candle break the zone and continue going higher, or it turn around on the zone to go lower. But you're looking for a big candle, whether it be green, whether it be red, you're looking for a big one. You don't do nothing till you see a big one. Before you see a big candle, What you can also look for is consolidation candles, meaning candles that don't know where they want to go at these zones. See how the market selling all the time, everything blue, and then we get a little area and the market didn't know what it wanted to do, right, on a lower time frame. No, you're not doing anything when you see these candles. This is not an actionable step, but it's an observing step. So you're looking. So I remember when the market reached to any one of them areas, you're looking to see what will happen. So you're being observant at the area, right? So if you go down to the 1 minute, you see how that look. Alright, market flip around. Now I wouldn't get into this strategy in particular tonight. I know let's kind of go for the basic, but this I would explain it probably next class. I have videos on exactly what you're looking for the market to turn around. I feel that'll be a little bit too much, right? But the market did do a thing in order to identify the reversal, right? But it's not exactly what I would like to show you. In terms of what consolidation that areas look like, it's look kind of like this. Marketing, you know, we're doing too much, chopping around. Still not the cleanest, but alright, it's look kind of like this, right? Kind of like chopping around. See the top body level, kind of just flopping around. It's not an actionable step yet, but it's something that they could observe. You know, you could see it reach up here and it consolidated. Meaning the market don't know what it want to do. So it could either it could break out and continue going higher, right? Identified by bullish engulfing candles. This is only 1 minute, or it could turn around, get like a big red one and continue lower. What we'll wait for is for it to break the structure. Once again, I wouldn't get into too much of that. Right? We're just looking at basically how to identify what we're looking for. First thing first now, right? At the levels. So we're looking at the market coming down and doing a thing. Right? So there we go back up. Right. So we're looking for the market to do something, which is either make a bullish or bearish engulfing candle. When we identify the bullish or bearish engulfing candle, right, we could then use it as an indicator. So I go back up. We could then use it as an indicator to make a determination of what might happen going forward in the market. Right? So the market reached all the way down here. It did a thing. We got bullish or bearish engulfing. That is our first indicator of what might happen. What a bullish or bearish candle signifies is the potential for the market to go in that direction. It's not definite, it's not guaranteed, but the possibility for it to happen is strong. Right? So remember, money has moved the candles. So the technicals, or what we're looking at on the chart, is a visual representation of people buying and selling, right? So when you see a big red or a big green candle, it's a visual representation of somebody buying or selling an asset. The people who can make these candles go up know why they're making the candle go up. So we're using this as a marker to say, well, hey, yeah, boy, the market continue going and going and go up. So that is our first indication. The next thing that we look for after we identify this, right, which is kind of like this shot, right, but I wouldn't go too deep into it. After we identify when the market, maybe possibly pick a direction to confirm is whether or not the market continues to go higher or then continues to go lower. So now we're looking again. So the first thing is to find the key levels. We found them. The next thing is to look for a bullish or bearish engulfing candle at the key level, which we did. The third thing is we want to identify if the market is going to go higher or lower. So to do that, the market just keeps moving the same way over and over, right? and we find a little area that it did it. So let me go with this area. So the market, let's do this. The market does push, and then it does pull. It does push, and it does pull. It does push, and it does pull. It does push, and it does pull. Right? So if you look at it like this, we could clearly see the market making higher highs and higher lows. Right? So the market, so you can see that this low area here, this area is higher than this area, which is higher than this area. So every time the market push and pull, it is making a higher low, meaning that the low area a little bit higher than the last, right? So this one higher than this one, higher than this one, higher than this one, right? Cool. Now this is if the market is continuously going up, right? Same thing if the market going down. Same thing. And there you go back. And so the market push, pull, right? Right, where's up there? Now the market keep making new areas of support and resistance. Remember, this is happening on any time frame, it don't matter. Right? Right, so we start here, we get up there, right? So the market making new areas of support and resistance. Now every time the market, so let me go with this area here. Every time the market pull, it is break one of these areas, right? So maybe you could take out this, or I might see it better. Whenever the market, let me say, pull back, right? We get a little pull. It is break one of these areas. Remember, we identifying bullish or bearish engulfings, right? So the market is break one of these areas, and it is pull back. It is turn around, and then it is push, and then it is break one of these areas, and then like here, it go pull back. And you go break one of these areas, and then you go pull back, and then you go break one of these areas. Alright, so we have, here's the next one. Alright, so every time the market continuously going in the direction, it just keep breaking these zones. So it pull here, right? Let me say it tap into here, because it come from down here. It come from quite down here. So you see we got a big one, pull back. This could probably draw here, right? Go up, pull back, chop around, no problem. Right? Break the zone, chop around, no problem. Break the zone. So it break, it pull back, it break, it pull back, it break, it pull back. Right? So this is how we could identify that the market is keep going up. Break the zone, pull back to the zone, and so on and so forth. What we looking to identify at our level is that. Now, if the market is going to go up, what do you think will happen? Remember using past data, right? So the market would push, it will pull back, and it will go, and it will pull back, and it will go. Right? We just identify that. Any time frame, over and over. What we looking to do is to see clearly when the market does that. So we could see here, this is the highest point the market reached relative to the price. So we have a little support area there. Right? A resistance, sorry. Right? So what we're looking for is for the market to confirm that it is indeed going to go up. So you see we get the bullish engulfing, no problem. We identify that this is a thing, right? What we then need is confirmation that the market is going to go in that direction. So remember, we're looking for buys. We're looking for the market to turn around. One of the indications of the market turning around is a bullish or bearish. What we want now is confirmation of a new high. So we need it to break the relative high that it had here and continue going up. So we're looking for this. This is how it is we're going to take our trade. So we identify the bullish at that level. You want it to pull back and then make a new high. A little bit more advanced is that you wanted to break the neckline. So you wanted to break the highest point that it was previously relative to the price. So this is where the market have a resistance level at. Right? This is indicated by this wick here. So remember, we're going relative to the price. Relative to the price is closest to where the price is currently. So what we're looking for is we could use this area here closest to the price as resistance. The wick giving you the indication this is resistance. And the candle went up here and turned around. Right, this candle, it tried to go higher than this and couldn't, and then it come back down. Right, so this come like a little resistance here. Now my fundamentals clear out this, right? So that's why fundamentals more important. Now I was telling man, close all the trade on a Friday because you don't know what could happen. Imagine if you did enter a buy trade up here, right? Because we getting higher highs. We start going out here, we get higher highs. So if you overconfident and you think, boy, we good and gam. We're going to get more buys, and then over the weekend, ting, and then now that jump your stop loss, when market open, your thing in the red. If it is, you could have hold the draw down, right? You might be lost your account. At a real man, I sure millions of dollars get liquidated with this one little move here, right? So what we're looking for to identify is for the market to either continue and show us that it is going to go higher in price, right, by making new highs. So we're looking for it to break the zone and then continue going higher, or it could chop around here, consolidate, it's not sure what we want to do, or it could go lower. Now remember, because we drew different points of interest, we know that down here could be another potential point of interest. So we have a point of interest here which the market did do something by, right, without a doubt. The market did something here, but in the case it don't do what we think it might do, we have another point of interest, which is here. So we could wait for the market to go here and then look for the same thing, or it could break the zone, you know. At the end of the day, it's take money to break a zone. It could break the zone. This is the next point of interest here, and next point of interest here. So it's always a point of interest that the market could go to, right? So at any one of these areas, something will happen. All we need to do is identify what would happen and, at which one of these zones. So even if nothing will happen here, something will happen eventually, somewhere. We're just looking for these key things. So we're looking for bullish, bearish engulfings at any one of these zones, and for higher highs to form or lower lows to form. So you could just sit down pretty much and see what happens. So if we zoom in, this is the 5 minute, we could see that the market make a mini support and resistance, and right now it's consolidating. What we will look to identify is if the market break out of this zone or break out of this zone. So this is where your alerts will come in. So you will set an alert, like we say here, in case the market break out. So if the market break out, we can maybe see it pull back and continue higher, as we now see that it does do. Right? Even if you don't understand what I say, no, it's fine, and we will keep getting into it. That's how they keep doing it. Right? Just stay on it now. So even if you don't know where you get lost, it's fine. Stay on it. Or we can set an alert below. Right? And wait. Anything outside of these alerts, irrelevant. We only want when the market break a zone to tell us something may happen. For it to break the zone, it needs money. For it to, that indicated by bullish or bearish engulfings. So we need a big candle to break out of one of these zones here to be able to then make a determination. Remember, when you see a big red or a big green candle at a zone in particular, more than likely the candle will continue in that direction. Right? So that's what we're looking for, to identify one of them big candles. That's what we're looking for. So if we don't get one of them big candles to break a zone, we don't do anything, right? Now, at these levels, this is a little bit more intricate, but I can't get into all of it. We'll go over it again. But at these zones, one of the things to identify, even if it's the big candle, is to wait for that candle to close above the zone, right? Now, I tell you, look for a big candle, yes, no doubt, but you need the candle to close full-bodied. So you check out this candle here, close. Now we got a better example. You see how this candle kind of break through the zone here and close full-bodied, relatively small wicks. Same thing, how this candle here break through the zone here and close full-bodied. That is what you're looking for. You're looking for the market to get one of those candles. A candle that break out one of these zones and close full body. You have to close. So they wait, they wait, the patience is coming and the men is beginning to chop up. These little things that chop you up. You see a big red candle or a big green candle, and well, you might go and buy. But then when you enter, the market is shoot down. The market is an algorithm. It is designed to take your money. Right? So it trap you in the wrong position. So that's for the impatient. So with trading, the market, let's take money out of the impatient hand and put it in the patient's hand. So when we sit down on our hands and we wait, man go get chopped up because they're thirsty. You have to click the button and then you get licks. You don't have to click the button. Clicking the button is one of the hardest things to not do. Imagine that. Now the hardest thing to do, not click it. Staying away from trading is one of the hardest things to do. That's not trading at all. Right? Because, people that say it's gambling, it isn't because it's gambling. You don't have an edge. Gambling is taking a risk on an uncertain outcome. This is something you can learn. It's a strategies. It's a game you can play. And like a puzzle. With gambling, you don't know where you're going to get. Right? However, it has evoked the same emotions. That's why you go hear people say about trading is gambling. It is, if you ever gamble, it is make you feel that type of way. And the emotion is what is chop you up. Right? So you have to be a robot in here. You can't have feelings. You can't be attached to the money. And that's what most people are, attached to the money. Right? But if you attach yourself to the money, this thing will take it. It's smarter than you. And they don't have no feelings. Right? So that's why we go in systematic and we go in data driven. Purely based on what we see. We're not taking trades on what we feel at all. It don't matter how you feel, what you're seeing. Right? So if the market going in against in the wrong direction, cut ties. It don't matter how you feel. I feel if it go up, it won't. Right? It's showing it going in the wrong direction. Right? So we're looking for the market to break one of these zones, close full bodied, similar to how we seen it here, and then retest the zone. Right? So you're waiting for the market to get a big candle, you wait to break it, pow, and then you want it to come close higher, pow. And then here, once we get a little chop around. Alright, so let me get a little chop around. So you want the market to come, break the zone, pow, you want it to come back, and then chop around. If you see the resistance, before it eventually go up. If it's when this thing and chopping around like this, yeah, they enter and close your eye. It could be wrong, but chances are you'll be right. Right? You only need to be right a little bit more than you're wrong. With forex trading, you can have, I think it's a 40% win rate and still be profitable. So that means you could lose 6 out of every 10 trades and still make money once your risk to reward is proper. Right? Meaning once your winners big enough, you could lose 6 trades in a row, get one, and still be profitable. So it there for you to make money, right? So that's what we're looking for essentially. The market to break the zone, pull back, chop around, right? Or just close, and then if we're looking like it pushing up a little bit higher, you take a trade, right? So I'm not indicated by what we looked at over on this side, right? That's what we looked at here. And as you get better, you would understand dojis and stuff. Right? You go see a doji and be like, yeah, but go take that trade. Right? So, mommy might chop around, the market break the zone, pow. You wait for it to come back. We just take buy trades on the red candles. and sell trades on green candles, better entry, better price. You want to sell something for the absolute best price you will get. That will be indicated by a green candle that you get at the top of the market, and you want to buy something for the lowest possible price. You will get that on a green candle, right? So if it's on a red candle, so if you want to buy something low price down here, red candle they buy at. If you want to sell something best price on top here, green candle they sell at, right? The other day I tell them fellas and they didn't even know that, so we learning from each other, right? I learned from binary options. For those of you who know binary now, I started out trading binary, quite decent at it. So break the zone, wait for the market to come back, be patient. You can't buy when the candle green. When the candle's green, it's going up already. After green candles, it's red candles. After red candles, it's green candles. That's why you want to buy on the red, so that you're more than likely, if you're correct, the candle will be green after. Right? Don't buy a green candle because you're due for a red candle. And you don't want to be due for a red candle and then you buy a green and then boom, red after. Right? You want to buy on the red because then you're due for the green. Right? And then you go up the road. So this here is a little chopper around that I'm talking about. So when the market pull into the zone, your chopper around is like a series of dojis or a series of wicks. Once you see 2-3 and them little wick, take a trade, close your eye. That is where the risk management come in. Put your stop loss below the low, right? Like we say, enter on this trade. Put the stop loss below the low. The low will be the last little consolidation area. Close your eye. Aim for at least a 2 to 1, meaning you will get 2 times your money at the very least to start, and go about your business. 2 things would happen: you would win or you would lose. It doesn't matter if you risk properly. More than likely, all you had to do is win a few more than you lose, and you're good to go. If you do this and you do it consistently and well enough, and you are correct, you will win trades. You will make money. Just do this enough times in a row. It's a profitable strategy. So you will lose some, you can always be right, emotions might catch you, you might do a little madness, all kind of thing, your jawline bad, all kind of thing. Anything can make you lose. Right? But if it is, you do it correctly, enough times, you will make money. So instead of the money, just focus on identifying these confluences properly. If we can identify when this is happening and take trades on them consistently, that is where the money would come from. The money wouldn't come from the money, right? The money would come from identifying this. So your focus, going back to the very beginning, should be to be able to identify these things. If we could identify it, then you would make money, right? Until then, you wouldn't get you. So remember, in our business, which this is, right, the last thing it does get is the money, right? You have to get your products, market, talk to your customers, set up your business, your aesthetics, whatever. You have to set the whole foundation of your business before you make money. The money is the last thing you just get in your business. You have to do everything else first. Stock up, build your business, market it, do all of that, and then you get money. So it's the same thing with this. Come on, learn discipline, patience, you know what I mean? Identify proper strategies, whatever, and then you make money, right? So the money is the last you will get. There's a weird area here, so I will see what's going on. I would allow trading for tonight still, right? The reason being is that because it's so easy to lose your money. I want to just jump in there and, at the first sign of anything happening, right? But this is looking relatively promising, right? to at least fill the little gap now. Now, tomorrow is Monday morning, New York session at the open. We saw London to go into. Let everybody play their hand, right? So this is still low volume because the institution is not here as yet, right? So New York session in open. New York session is in New York Stock Exchange. That's where the most volume is coming to the market. So you want to at least, if out of Sunday to Monday, you want to at least get them fellas out of the way. Let them pick a direction. Let them do something. You know, we still have London session. We just have good volumes like 3 in the morning. Let them do something too. Right? Gold is one of the most traded assets. Right? We have plenty news and fundamentals. Let them fellas and them play the hand now. You know, let them get out of the way, and then we go jump. You know, it's a little bit calmer, more safe, and less volatile. It's not volatile right now, but it's due for volatility. Right? It's due for big boys to enter and do things. They can't enter and do anything now. So it will be the retail main move in the market. So for now, I would still lower it and just observe. Let me see what this gap do. Right? Let me see if the market pick our overall direction. Right? It's a weird place to be, especially with gold. Could be buying all the time. Then things easing off. So we have to kind of see what's going on. And then based on that, I would know when I could safely say, well, the market settle a little bit, and then take a little trade on that buy, right? So it's not quantity of trades, it's quality of trades, right? So you will get there. So take all the time, right? So I would advise, or let's at least let Monday pass, because we have news in the morning, do we? Right? We have 8:30 news. CPI. So you want this is I read folder news. This is still a major news event. Let this at least run out. So the New York session, let this pass. Right. GBP news 2 o'clock this morning. So it have the US dollar and gold let's move kinda adversely. Right. So you want to let's get some New York news, some US news out. Plenty things are going on. Right. This is there is a news wiki as we see it. Plenty red folders. I know Thursday for sure is a big one. You see this man? Jerome Powell. This man, boy. This man say good evening. Big red candle. Right? Unemployment claims is a big news event and all too. This is forex factory, so we could come here and look at Powell. I want to say good evening, boy. Market moving. All kind of thing, right? So we just want to be careful at these news events. So we have a news event that would move counter to the US dollar, right? So we want to just let us pass here. We want to hear what's going on tomorrow for CPI, that big news, and then after tomorrow CPI, then I could kind of get a gauge as to what's going on. We will have some good structures. The market would make good zones, and then we could look for some entries on that. Alright, so we at 8 o'clock, you'll take some questions, and then we go bust out. I don't like the classes to be too long. I always get diminishing returns. Alright, so anybody have any questions? Alright, no questions. So I will see you all in the chat, only see you in the group, right? Later.